Welcome to Streams of Income with self-help author Ryan Rieger. For the next hour, you'll hear proven methods for how to live the multiple income streams dream. Ryan is passionate about helping others discover their gifts and start their own business. He's published 5 books, and his courses and group coaching programs have changed the lives of thousands of students all over the world. Ryan's books include Private Label, The Easy Way, Finding Your Grace Place, and his latest, Streams of Income. And now, here's your host, Ryan Rieger.
Hey guys, welcome back to the Streams of Income radio show. I'm your host, Ryan Rieger, and today we have Chris Volk with us. And this episode's a little bit unique because my buddy Stephen Hibbert, who has been on this podcast many times, helped me with this interview. Chris is super smart. So this is almost like a MBA right on this podcast. And so I knew Stephen would be helpful in asking really good questions of this guy. Chris is the author of the book, The Value Equation. He has taken several companies public, and he's just got an awesome background in finance. And we just had a great conversation. So for those of you that are a little bit more academic, you're going to love this episode because we talk about things like, revenue and increasing your revenue and how to do that using his formula. And one thing I asked him that I'm always fascinated with people who are around a lot of different businesses. You pick up some things, you learn things, you see how other businesses have become successful, and you see some parallels, you see a lot of similarities. And he said one thing that he always suggests businesses do is to create core competencies, be good at a few things, and focus. And he says, as a business owner and an entrepreneur, it's very easy to have shiny object syndrome. We all know that, don't we? And but you got to focus and have some few core competencies that you are really, really good at. You focus on those, and it'll help you be much more successful. But he said some really, really good stuff. I took a lot of notes here. Business is fundamentally virtuous, and we all know that. And my friend Rabbi Lapin talks about that, how business is good. And so if you're in business, you're listening to me, you're doing a good thing. But this has been a really awesome episode. Grab his book, The Value Equation. You can grab it at Amazon. But here is my interview with Chris. Christopher, welcome to Streams of Income. Thanks so much.
Ryan, I'm just excited to be here with you.
Awesome. So as you guys can see, we have a little bit of a unique episode here. Stephen Hibbert's on with me because my audience he's no stranger to my audience. But when I saw Christopher's request come in to be on my podcast, I thought this will be an episode that Stephen will want to be involved in. Will help me ask really good questions. But Christopher, I want to hear your story. I love hearing people's stories and how they got to where they are now. So feel free to take me back as far back as you want to go. That my audience might find interesting.
Sure. I started my career not knowing a thing about business. I was actually selling clothes in retail, and I thought I should take some business classes to hone up a little bit. So I was taking accounting classes at night, and got a job working for a commercial bank, which I did partly because if you're working for a bank, you may want to be in banking your whole career, but if not, you're seeing a lot of businesses, right? I mean, you get to see what other people do and how stuff works. And so I did that for 6 years and decided I didn't like banking that much, but I sure did like finance, one of my customers, I was in Atlanta at the time, one of my customers was out in Arizona, and he had a company I really liked. It was a sort of a real estate company, but really fundamentally it was a finance company. What it did was it bought all these chain restaurant properties and rented them to all the operators that ran the chain restaurant properties. So it was basically convincing people they were better off having a landlord than a banker, and it was a better idea to finance their properties. And so he started that company in '80. I joined him in '86, but I'd been banking him since before that. And somewhere kind of in the late '80s, early '90s, I suggested that he take this thing public. So I led the public IPO for this. That was in 1994, and we listed on the New York Stock Exchange. We were there for 7 years, and I was the president on the board of directors, and grew the company pretty substantially. And we sold it to GE Capital. So we were part of. I was going from running a company with 250 people to being one of 350,000 employees in GE, and that was not my favorite thing to do, and so I left a perfectly good paying job to take a risk to start a company. And I think that, part of this is you have this notion of what do you want to have on your obituary kind of thing. And part of my thing is that I had a bucket list, and I wanted to be able to look back and say I tried to start a business. And it was important for me to see if I could make a go of it. So he and I got together. We created another real estate investment trust doing net lease assets similar to the first company. Although this was beyond restaurants, we were doing a lot of other stuff. We were doing data centers. We were doing all kinds of stuff. So we started in 2003, took it public in 2004, sold it in 2007, stuck around for a little bit. And then in 2010, we had left, and I was approached by a group out of California to potentially capitalize another business. And so I took a group of people with me to start that business. And in May of 2011, we started that, and it was called Store Capital. The store today is still in the New York Stock Exchange, and I ran it as the founding CEO for 11 years and grew the company to somewhere around $9 billion in equity value. And
only $9 billion.
Yeah, and then at the end of somewhere before 2010 or whatnot, again, on the notion of what do you want people to say on your obituary, I thought, well, I want to do some other stuff besides just running a business. And so I took a lot of the thoughts I had on how businesses should get put together, and I put it in a book which got published earlier this year, and it's called The Value Equation. And here it is. And I've been talking to people about it and trying to sort of change people's views on how they look at business. And my observation was a lot of great things about business aren't really taught at business school, or certainly not taught very well. And so this is a pretty original book on finance and business, which is kind of hard to find a rare, an original book on finance anymore. But it's finance-driven book on how business models are created. And so I've been teaching. I've been doing this. I'm helping businesses, and I'm having a great time.
That's
nice.
Awesome.
I have a lot of questions, but
Go for it, man.
I think finding the driving factors for what you were doing, finance was the thing that you feel like led you down this current path that you're on. And when did you identify that? Was it before the accounting classes, during the accounting classes, or like working at the bank that you found that that's the thing that you enjoyed or wanted to key in on?
When I was working at the bank, you got to try all kinds of stuff, and I got to spend a lot of time in the credit department analyzing financial statements. And I started to realize that I was good at this stuff. I mean, and I enjoyed it, and so I started modeling out businesses. I mean, from an early age, I was really in my career, I was modeling out companies, and so that worked all the way through. I mean, I still model out companies to this day, and when I did the value equation, part of the centerpiece of the value equation is that you could take any business at all. I mean, it doesn't matter what the business is, and reduce it down to 6 variables, and so the idea is to make things as simple as possible so you understand what to focus on. And early on, when I would model out companies, it would get hugely complicated. And so, and I have spreadsheets with like all kinds of lines. But when you can do 6 variables, then you can almost toss away the spreadsheet, right? I mean, and you can and drill stuff down. When I would give people discussions about Store Capital, I go to investor day events, and I would talk to people about our company, and I would give them a financial model. I do a 5-year projection for them, and I would do it with 14 variables, which is pretty amazing when you think about, you're running a company that's got $9 billion in equity cap, and you're doing $600 million in revenue, and you can reduce the whole thing down to 14 variables, but it works. And so the idea was to sort of create value, and so I wrote a book on how to do it.
So I think most of Ryan's audience is e-commerce. I think as they start generating cash, they're looking for other business ventures. It seems like your ability to build out or do 5-year estimates on business through your equation is refined down through a lot of different things. But from maybe your first, like working at the bank, just testing and trying to see what you enjoyed and liked, to that next jump, what was that? Obviously didn't know the formula, but maybe the feeling or passion was the thing that got you going from like, this works, but this isn't really what I'm called to do? How did you transition into that next like phase from going either from a job into something that you enjoyed a lot more? Were you doing those business evaluations at the bank, and then that was a thing that you like, I like this way more, that's what I'm going to go into?
Well, I started, when you're in banking and you're in credit and you're seeing all kinds of businesses, you just learn pretty early on that some businesses are just flat better than other businesses. I mean, and if you look at like the Forbes 400 list of richest Americans, those people have a tendency, by and large, to be in just amazing businesses. I mean, and there are a lot of things that make those things amazing. And so I saw just company after company after company, and I've gone through thousands of them. And in fact, if you look at STORE and our two predecessor companies, we provided real estate capital to thousands of companies. So I had a good insight into everything from restaurants to veterinary clinics to you name it. I mean, retailers to manufacturers, and you're looking at who's got the best business models, who's just really got it down, and they're creating a ton of value for both themselves and their shareholders and their employees. And so that sort of became a passion. And when I chose the company I went to work for in Arizona, part of it was because they had a great business model, and I enjoyed it. Passion's a funny thing. People talk about following your passions. I think that passions kind of emanate from what people are good at. Oftentimes, I mean, so it's a sort of Malcolm Gladwell. If you spend 10,000 hours at it, you start being pretty good at something, and if you're good at something, you tend to start liking it more and more.
Yes.
And then people who start companies, the motivations oftentimes aren't just surrounding a personal passion. It starts off with, I want to work for myself. I don't want to work for somebody else. I want to make my own mark. I want to be, have more autonomy. And then they get a joy out of creating jobs for people. I mean, you hire employees, you've created jobs for people. You like working with them. That's hugely important. And you are providing a value for customers. The customers are happy. So companies, I find business is fundamentally virtuous because it has to be a win-win-win thing. It's got to be winning for the people that are in it, and it's got to be winning for the customers, winning for the employees, winning for the suppliers, the lenders. It has to just win, And so one of the things I like about business fundamentally is I just think it's just virtuous, and I just enjoyed all of that, and so that became kind of my passion, and I think it's reflected in the book.
I'm going to jump here and ask a question, Christopher. Does it annoy you that popular culture paints business people as evil? Movies out there, like the business owner is always the evil person. In the Lego movie, Mr. Business was a bad guy, and like business is great. Business was what I feel like entrepreneurs like us, we are what drives the world, in my opinion.
It does bother me, and I think it's because the news today likes to gravitate on bad news, and they're always, there are bad people in every walk of life, right? So there are some bad characters in business. Yep. There are people that are good characters in business, but they just make really bad mistakes. So that happens right. too. And all that stuff tends to get on the front page of a newspaper, right? But meanwhile, there are thousands upon thousands of really capable business people out there. And I define success in business from a financial perspective as having a company that's around for probably at least 10 years, doesn't lose money for the investor. I mean, for the person founding the business, provides that person and their family with decent living. That's success. Okay.
Yes, it is.
Then there's the question is what's outperformance? Okay. So outperformance is where you have a company and it becomes worth more than it costs to create. And most companies actually don't rise to that level. Most entrepreneurs, if they had to sell their business tomorrow, they would be fortunate to get what they paid for the business. I mean, they've made an investment, they're just getting out, they're going to go do stuff. Exactly. But if you look at the people on the Forbes 400, and you don't have to go there, you can go way, 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 way down. I mean, these are companies where they, without fail are worth substantially more than they cost to create. And you're doing that by having a strong, potent business model. And so I started focusing on how do you do that?
Yeah. Awesome. And we definitely want to get to that. We want to get into your book and make sure that that you get out what you want to share for sure. I know, Stephen, you probably have another question or two, or you have more, but
I got a lot more personal questions now. But I think I'm just thinking about your audience, Aaron, from like the transitioning of. I use passion, but I think you clarified it's not passion, it's really what you're good at. I think in the e-com space, I think every e-com business is set up a little different, but you can look inside yourself and see what you're good at and let that guide you to the next business venture. But I think the way that you qualified, like some businesses are run better than others. Do you have any like short answer to say like focus more on these types of businesses than these types of businesses? Like restaurants are, I guess, notoriously difficult to run, but coming in and I guess partnering with them and letting them not be on the hook for the bank, but the lease, so it makes it easier to walk away or less stressful, was very interesting to me. Do you have, I don't know if you know the e-commerce space, but do you have a guiding light for like stay in these businesses because these businesses tend to be more successful?
Yeah. The answer is not that simple, so over the years, I've financed countless restaurants, obviously, and had countless customers of ours develop very substantial net worths. I mean, and so now you generally won't see restaurant people in the Forbes 400. There are about 2 or 3 of them that are there, but most of the ones that are there aren't really just in the restaurant space. They're in the franchising space or something like that, which is a little bit different. Well, no, McDonald's is in the Forbes 400. It would be Chick-fil-A, the Cathy family, In-N-Out Burger, would be another one. Those are the 2 chains right today that would be in the Forbes 400. But it's super rare to have people that would be in the restaurant space because it, one of the things that characterizes a great business is to have strong operating leverage. And operating leverage is the idea where you can grow your sales substantially without really increasing the investment you made in the business in the first place. But in the restaurant space, there's not that much operating leverage. You grow your sales, you have a restaurant location. To double your sales, you got to build a second restaurant location, right? And to double it again, you got to build 2 more restaurant locations. So there's no real operating leverage. You're investing every single time you're doing it. Whereas if you're in technology or software, once you've created the code, once you've made that investment, you can sell untold amounts of it without really increasing the amount of investment that you've made into it. And so, but that doesn't mean, by the way, you can't be in the 1% in the restaurant space. You can be well within the 1%. And by the way, the 1%, just to define it for your audience, is having a net worth of 10 million or more, something like that, right? And so about 12% of Americans are millionaires. And about 2/3 of that group made their money in business. And the reason why it's 2/3 is because you can't save enough. There's not like if you focus on trying to save and putting money into a 401k or to an IRA, it's really hard to save $1 or $2 million for most jobs in America, right? It's just incredibly difficult. So to get to 10 million, unless you're a pro athlete or unless you're somebody making a huge amount of money, trying to save 10 million is really, really difficult. And so the people who get there are heavily in business. By the time you get to the Forbes 400, they're all in business, everyone, and without any exception at all. So business is the most assured way to get in the 1% of any place I know.
That's good.
So from jumping off that question, is it better to build or buy into a business?
I have no preference. I mean, I've watched people buy companies over the years and do incredibly well. If you look at private equity firms today, and there are about 10,000 private equity firms and venture capital firms in this country, up from pretty much 0 when I graduated from college. And if you look at them, a lot of what they'll do is to buy existing businesses and then maybe roll up businesses. So they'll buy one veterinary clinic and then another one and another one and make them bigger. And they can do a very good job of creating a lot of wealth by executing strategies to buy businesses. And so but I've also seen people pay too much for businesses. I mean, and if you pay too much for businesses, it's really hard to reverse that. I mean, and if you get into the public company realm, something like 90% of M&A deals just fail because people integrate them badly. They pay too much for them and make all kinds of other mistakes.
Is there a place where they could, when you're saying pay too much, they're pulling money from the bank, not necessarily like structuring a owner finance type deal?
Well, I mean, so banks in general aren't going to lend money unless there's cash flow on a deal, right? So, I mean, some companies got to be cash flowing. The bank's going to lend a certain multiple of that cash flow against the value of the business, and then you got to plug for equity. So you're plugging for how much money you have to show up to be able to invest in equity. And if you don't have that money, then you're going to have to sit there and figure out how to raise the money from somebody else, or have the seller carry back a note. I mean, there are all kinds of tricks that have been used over the years to be able to buy companies properly. And every now and then banks get overly euphoric. So every now and then banks just lend too much money, and every now and then, customers or investors rather, when they're buying companies, they get euphoric and they just pay too much for a business. And then, sometimes you get people where they're both euphoric, and they and it feeds off each other. You look at a company you look at a company like Twitter today that just got bought out, and the debt's trading at something like 60 cents on the dollar. So the people that just financed it are actually underwater on their debt, and Twitter's doesn't earn a profit. So Mr. Musk and his other investors have to figure out how to make that company earn a profit. Because if they don't earn a profit, they can't pay back the debt, and they're not going to also generate any return on the investment they've made, which is also paramount.
Yeah. Wow. Steve, I know you could probably ask him question after question after question, especially because your background, but I want to get into your book, Christopher. Tell us about the value equation, what that is, what is the value equation, and let's jump into that.
Well, sure. So it starts off with, you're running a business. There are three basic things that people focus on. And the first thing they focus on is what I call operating efficiency. So operating efficiency is sales, costs, trying to improve your operating profit margin, which is your cash flow before you pay off any debt.
Yep.
And the second thing that people focus on is what I would call asset efficiency, which is basically every business to create you got to make an investment, and that investment might include real estate. It could include accounts receivable, inventory. I mean, it's an investment. Mm-hmm. And so what you want to do is make that investment as low as possible, and figure out how not to finance stuff. So if it's inventory, try to figure out how to have somebody else own your inventory. If it's accounts receivable, try to have people pay you on cash or credit card. I mean, you're trying to figure out how can I make the investment as low as I can possibly make it. If it's real estate, by the way, you might think about how do I find a guy like Chris that I can rent the real estate from. So I don't have to put my money into the real estate. So you're trying to make the investment as low as you possibly can. Yeah. And the third thing is capital efficiency, which is how do I finance this thing? Where's the debt come from? Where's the equity? If I have to have equity, where does that come from? Is there a way that I can raise equity from other people to help with this? I mean, which is what people do on Shark Tank every week. When they go on to Shark Tank, they're trying to figure out how to raise money by giving away as little of their company as they possibly can, which is a fine American tradition. And so, so you're trying to figure out how to structure the capital stack as efficiently as you can. Mm-hmm. So those are the three things that people focus on, and they're all three of them equally important. And those three things create 6 variables. And so I won't go into all the 6 variables and define them for you. So your readers, your listeners are going to have to go look up the book, and it gets into a mathematical equation. But basically, you're taking those 3 variables, you're creating 6 variables around them, and you're creating a simple equation. And what's interesting about it is that the numbers almost cease to matter. What really matters is the relationship of the numbers to each other. And so it doesn't matter what the business is, whether it's selling a dollar in sales or $10 million in sales or $1 billion in sales. The number itself just doesn't really matter. It's all the relationship between, your investment and your sales and how your capital stack works. And those relationships create equity returns. And when I was running the companies I ran, my goal was to achieve equity returns, and the value equation computes what I call a current equity return. So not the total return, but what's the return today for an equity investor. And my idea was to create a return today and a total rate of return on equity that was going to be more than investors really needed. And if I could do that, then I could create a company that was worth more than it cost to create. And so my goal was to be able to do that. Now, the stock market, just to put it in broad context, the stock market has generated about a 10% rate of return for a long period of time. Since the S&P 500 was created, it's been kind of in the 10-ish range. And if you're looking at rolling rates of return, whether it's 5 years, 10 years, 20 years, 30 years, the median return is kind of 10. So that says to me, as a public company CEO, gee, it'd be nice if I could generate better than a 10 for investors. I mean, if I'm going to make investments, I want my investments made to be able to generate more than a 10. Because if I don't do that, then my company will generate a nice return. It'll generate 10, but it will not be worth more than it costs to create. So I want it to be worth more than it costs to create. And so we would focus on being able to create an operating model and a business model that was designed to create a return that was higher than what investors wanted. And by doing that, then we were able to create companies that were worth more than the sum of their parts, which is what you want to be able to do. And that's where the most wealthy people in the United States generated their net worths, by and large.
Okay.
That's a fascinating concept. I don't know if I've heard of it thought out like that, where you're purposely building the business on the return side for the investors. Is that how banks normally operate from that standpoint? Is just thinking about the...
I don't think most people operate from the standpoint. Several years ago, there was a company called Stern Stewart, it's a consulting firm, and they came out with a concept called economic value added, which was basically to calculate how much value was created every year by a business in excess of its cost of capital, right? And so the idea was that you would take a profit and loss statement, and you wouldn't just put in the cost of debt, the interest cost. You put in a charge for equity too, right? And so the idea was to have a P&L where you're creating a spread over your entire cost of capital, both equity, equity and debt. And I was fascinated by that, and I thought that was right, but it's very hard to calculate. Like your average investor really can't calculate it
equity
that easily.
Yeah.
And so what I decided to do was to turn it into a yield, a rate of return, like as opposed to having an absolute number. The value equation calculates a current rate of return, and so I started being enamored more with the rate of return than what the actual EVA number was. Now, the idea of EVA was that if you could every year create value above your cost of equity and debt, then what you could do is over time you would create what's called MVA, which is market value added, which is a company that's worth more than what it costs to create, right? And I started being way less concerned with market value added because I don't really care if my lenders make money. So let's say I have a lender and they lend me some money and our company does really well. And unlike Twitter today, our debt becomes worth 120 cents on the dollar or something like that. Well, okay, I'm thrilled. My debt guy has made 20 cents. That's terrific. I don't really care about that. What I really care about are the shareholders. And you're running the company for the equity guys. And so I stopped just thinking about cost of capital altogether, and I just started thinking about cost of equity. And the idea was if I could just generate a higher equity return and simplify it, than my investors really wanted to have, then I create MVA, because when you think about MVA, most of that money really goes to equity guys. I mean, very little of it goes to debt guys. And so I just got focused on the equity side of it. So what you've got in the book is sort of the framework I used, and it walks through the companies that I ran, but it also walks you through, the FANGs. You can look at Apple, you can look at Amazon, you can look at different business models and see how they do it. And all the models are different, and then you can look at it from an investor perspective. Let's say you're buying stocks. I mean, you can do the same thing, because the business investment when you're buying a stock is different from when you're starting a company. And most of the times it's because you got to pay more to buy a stock than you would have to if you started the company, right? And so therefore your returns are way less than the original guys that were there, right? So returns that Steve Jobs and Wozniak made, they're much higher than whatever any current shareholder of Apple is going to get.
So does that, when you're thinking through that equation, do you ever put yourself on the other side of that as the shareholder also? Is that another way to incentivize yourself to think through this a little bit more strategically? Because then it's truly benefiting you?
Always. I mean, if you're running a company, I said the great thing about running a company, you're benefiting from the help that your whole staff and the whole business is generating, right? I mean, so you're always thinking like an owner, right?
Is it an owner or a shareholder?
Same difference to me.
Okay.
I mean, it's sort of like when Warren Buffett buys stocks. I mean, one of his comments that I love was that early on he was investing in stocks. He was buying stocks, and then later on he decided that approach was really wrong. He was just buying companies. And you may own only a small piece of Coca-Cola, but or American Express, two companies he's held for a long time. But he viewed it as being able to buy a company, and so he's analyzing it from that perspective. So in a way, he's looking at it very much like I would look at it as the founder and leader of a public company trying to create value for my investors.
Okay. So I guess that's why when I asked that question, like buying or building, it's kind of the same for you, because you're looking at it from the same perspective. It might be more front loaded if you're building it for the risk and the equity, but if you're coming into it, it's like you have to figure out where on that piece that you're at, what risk are you taking versus reward that you might get. The risk reward might be very high in the beginning, but I think if you're evaluating the business as the same, you can calculate that much easier from a starting position because of the position you're trying to put yourself in. You're trying to think through the business as that 5-year business that's set up. What is this actually generating? And is it actually going to be building a business that is paying out more than the time, energy, and effort I put into it originally? How long does it take to kind of think through that? That sounds like a wildly different. I mean, I've started a lot of businesses, but I've never thought of it quite like that. And I think now as I get older, I'm thinking about businesses of like from the buy sell perspective. Like I've always I joke with Ryan, his audience has heard this too, like gasoline fire is normally how I'd leave the business. Talking to some more business brokers recently, they were like, you left so much money on the table. I was just like, oh, I didn't think about it like that. It was more skill based is what I was looking for. But I think if I would have went into it thinking through the business of like, I am a shareholder in this business, what does this look like? And if I'm not that's what I was saying, like business owner of this, and I need to hand this off and then become a shareholder, the business needs to operate the same way. But I guess all that to say, from starting a business, thinking through this perspective, it seems like it's pretty easy math. If I sat down and thought through it and added up the numbers, do you feel like this takes months, years to kind of understand, or does this seem like a simple enough concept that like if I get it, I could sit down and kind of stretch this business out 5 years and feel confident that I'm moving in the right direction to be able to create a business that's going to be able to profit more than the time, energy, and effort that I put into it? I know that was a lot. I apologize.
No, that's all right. It was sort of, so as I'm learning about you, Ryan, I'm seeing you've got a book out there, and one of your advices to people is that if you think this is really easy, it's not. If you're going to get rich overnight, it's not going to happen.
Yeah.
And so people who, your audience who wants to get into business and create a company, it would really help them to understand just sort of the fundamentals of business models, right? And to do that, it's going to take a little bit of time. They have to invest some time in this, right?
Mhm.
Now, the good news is the math is all middle school math, right? I mean, there's nothing fancy about it.
Right.
It's all division and multiplication. So there's nothing fancy about it.
You
But
get to cheat and use a calculator. You don't have to do it in your head.
yeah, but the concepts can be hard to like grasp. Like you got to think through it, and to be able to sort of be fluent in the language of business takes some time, but it's really super worth it if people are doing it, because they better really understand what it is they're getting involved in and what the risks of that are. And I think that it gets down to when people talk about, for example, re-engineering a corporation or setting goals, it comes down to the 6 variables. I mean, it's coming down to shareholder returns. I mean, you're not running the company for your health. I mean, you want to make the company, create value too, right? I mean, you want it to be profitable. And so fundamentally, every year, if you're sitting down with your staff and your team and you're focusing on how to run a business, it's all focusing around trying to make the business model better.
Yeah. This sounds like this book needs to be in college curriculums instead of the boring business books that they're reading now.
Well, I'm working on that,
Good.
And I think that's true. I mean, I think that the material should be there. When I see people that graduate from university or from business school, even, you oftentimes have to teach them how to read financial statements. I mean, to spend time being able to interpret financial statements, which means they can all calculate a net present value, or they can calculate an internal rate of return. I mean, these are sort of things that they teach you in business school, but they don't teach you how to be an owner and how to put all this stuff together. Look at a whole balance sheet in the company and how the business model matters, and there's no internal rate of return or net present value at all in the book. I mean, it's I ran public companies using this. I mean, and no one taught it to me in business school, so I had to learn it for myself and create it. So the first article I wrote on the value equation was in 1999, and then I started writing other articles. So in a way, the book is sort of the consummation of 20 plus years of doing this.
Awesome. Congratulations on it too. And before we wrap, Stephen, I'll let you get some more questions too, but I'll make sure we answer the question. Where can people find it? Because I know folks are going to want to grab it.
Amazon.
Oh, it's on Amazon, and it's on Apple Books and anywhere, Barnes and Noble, whatever. I mean, so it's out there.
Awesome.
And if people, look at it and love it, I'd love to have a review too, by the way.
Yes,
so
for sure. That's very helpful.
I was going to come more from you're constantly looking at that bucket list. Was something on there teaching? And I mean, I might be saying this, but you teach at Cornell or taught at Cornell? Was that something that was on your
I've taught
bucket
at Cornell, and I've guest lectured at other universities. It is sort of because, in a way, part of what you want on your obituary and whatnot is that you made a difference to other people,
Yes.
right? So, and so, starting a business isn't everything. You want to be able to contribute to other people and to what their future is going to be. And in a way, when you teach, you can touch more people. When I do a podcast like this, I can touch more people doing it.
Absolutely. Yeah. Do you feel like this book is obviously for people who want to start a business, but if they have a business currently and want to just increase the revenue, make it more profitable, is this a good fit for them too? Yeah.
Well, the title of the book is The Business Guide to Wealth Creation for Entrepreneurs, Leaders, and Investors, which that's a pretty big group, So, and if you're working for a company or you're thinking about what you want to do with your life, you're trying to think about what kind of job I want to have. It sure does help if you're working for a company that's got a great business model, and for people that understand the importance of business models. And people that are working for companies that have solid business models tend to have much better resume fodder. They tend to probably get paid more. They've got better career mobility oftentimes. If you're an investor, if you can look at a company not just as a stock, not as like, I'm going to buy GameStop today because some people are, it's a momentum thing and I'm going to just buy that. But if you're really reading financial statements. And by the way, this is a little bit of a lost art because, roughly 2/3 of the trading volume in our stock, when I was running the company, would be done by people who didn't even have a clue what we were doing. Which happens all the time. But if people will read it and really understand what businesses are doing and how they're creating value, they'll make better investment decisions. And then, I imagine there are a lot of people that think, well, gee, I'd like to be an entrepreneur someday. I'd like to take that risk and start a business. What's it going to take to do this? And this book will give you an idea of just not really all the steps you have to go to start a business, but it'll give you an idea of how the financial model needs to work and what it is you're trying to do from an objective standpoint, and how you can create wealth. The goal for sure is you'd like to be inside the 12% of Americans that are millionaires. The number drops to 6% for those that are worth, so you're 12% for $1 million. It's like 6% for $2 million, right? So it just tells you how hard it is to get to be $2 million. And by the time you get to 50, it's 1%, right? If you're a billionaire, you're in like 1/1000%, right? So it really drops off a lot. But so you want to be somewhere, a win would be certainly between like the 12 and the 1, somewhere. If you can get there, that'd be a massive win for anybody. And it's totally attainable. I mean, completely 100% attainable. And especially in a market like we're in, because since you got 10,000 companies out there that are looking for good ideas and good people and good management teams, for the people on your podcast who are listening in, if you got some good ideas and some good folks and a decent business model, you should be able to raise money to start a business. And that's what I've done multiple times.
Do you think with somebody who's getting ready to start a business or in raising capital, if they have read your book, they're going to sound a whole lot smarter to potential investors than somebody else who goes about it the old way?
Without question. No question.
Are you ever disheartened when you talk to business owners and it seems so wildly like they don't understand their finances at all? It's been very eye-opening to me now, talking to a lot more businesses and thinking about buying businesses and talking to more business owners and talking about their P&L, or they don't even know what a P&L is. It's just like, it's wild to me to know that people can start businesses and not know, I think, the foundations of business. Do you see some of that same stuff when you're dealing with lending money?
Well, yeah, because when business leaders sometimes succeed in spite of themselves, which is what you're talking about, then they could succeed so much better if they really focused on elevating their business models. And one of the things that I would see from time to time, just as an example, would be where a company would want to sell itself. So not too long ago, I had a company that they rented construction equipment. So they're running cranes and front-end loaders and that kind of stuff. And they're in Texas. They're trying to sell themselves. They sell themselves to a gentleman out of Atlanta. And the price he paid was equal to just the value of their real estate. I mean, so they basically then turned around and did they sold the buildings to a landlord and rented the buildings.
No money deal right there.
And it's no money deal. So what you get is the seller of the business didn't really understand one of the pillars of business value, which is capital efficiency. They didn't understand the pillar, and failure to understand that pillar is like really important, because you can really shortchange yourself when you're selling a business, And so it just never occurred to them. They just didn't know that somebody could go off and do this. And if they'd known, they could have done it themselves, had the same amount of money, and still owned the business. So you have things like that where people just don't pay attention. They just don't continue to learn. And it's important for all of us as business people to try to do our best to continue to learn.
Yes.
I am becoming a buyer. That story is very helpful to me. I was in the process of buying some notes. We just went to a conference, and I was in the process of buying some notes from a hard money lender who's having a tremendous success, but I think it's in spite of himself. So I was going through the financial calculator on a 10B2 with him, and he was just like bewildered by anything that I was doing. I was just like, this doesn't make sense to me that you can have this much success and not know, like, you're lending money. I would assume you'd need to know, like, some of these concepts, but I think there's a lot of opportunity in the buying side if you have a better foundation. And I think now hearing you tell this story, I should have bought those notes. I just felt bad because I was like, this feels like I'm taking advantage of this. It's not what I'm looking to do. I'm just trying to show him how you can increase.
No, if you look at our history or my history over a lot of years of putting out money, some of the biggest money losing deals that I've been part of are buying real estate and leasing it to people that have all the equity in the world and they just flushed it, And then on the other side, some of our most successful stories are buying real estate and having as a tenant someone who has no equity in their business. And so people can make the decision to buy companies, and sometimes you get a really tremendous deal, and sometimes people can make just horrific mistakes.
Wow.
Okay.
Wow, this is good stuff, Christopher. I want to, but you prefer Chris or Christopher?
Chris is good.
All right. Last question, and we'll let you go. Appreciate your time. You've seen a lot of different companies. You've seen a lot of different business owners. What's some advice you'd give people who are starting a business besides get your book? Just because you've been able to see a lot of businesses. So what are some things you've seen that would turn into some success tips or just advice you'd give somebody who's wanting to start a business?
Well, first thing is that all businesses solve problems, sometimes if you're doing e-commerce, for example, you may not think you're solving a problem, but you are. I mean, somebody's buying what it is that you're selling,
Yep.
And so, and they have a need and you're fulfilling that need. So all businesses exist to solve somebody's problem, and that problem could be everything from serving a meal to launching satellites into space. I mean, and so as you're building a business model around it, you have to think about why it is that people want to buy from you, what's the problem you're solving, and then how to craft a business model around it. Like, for example, I think about one of my favorite companies has been Google for a long time. And so when Larry Page and Sergey Brin started that company, they had an idea for a much more efficient way to browse the web. So then the question is, well, how do you turn that into a business model? I mean, these are PhD students who are dreaming up something that's sort of fairly academic, probably at the outset. And then the question is, well, how do you take this academic thought? I mean, I just give people a better way and turn it into a business model, which they did. So you're taking an idea and you're crafting it into a business model. The next thing is you have to have a good team of people with you. I mean, very few businesses are started by just one person who runs it. I mean, because that's just a proprietorship. It's just you. But if you have a company, you tend to combine folks with complementary skill sets, and you all aren't good at the same things. So, and you're putting a team of people together, and really good teams of people are hard to find. I mean, they're almost harder to find than the money, I think. So if you're trying to go off and raise money from people to invest and back you, it really helps to have a very solid team of people. And the last thing, for me is you're putting together a company, and you're thinking about why would somebody, invest in you versus other people. I mean, you have to always think, what's my edge here? Because companies that, even if they're starting off, they have an edge. It may be a small moat, but they have an edge, right? So, and why would people work here, and why would customers buy here, and so on? And then you're thinking through core competencies. And I know that people talk a lot about value statements, and I like value statements, okay, but I find that every value statement I receive from a company, I like them all, but they all tell you that, you're supposed to be honest and the customer comes first. And I mean, they all say kind of the same thing. It's just Amazon's going to say it maybe differently from Walmart or something like that, sure. But they all fundamentally say the same thing. But the real issue is core competencies, and it's what are the things that you're really good at. And when you're starting a business, one of the hardest things for entrepreneurs to do is to focus, because they're all pretty creative people. They tend to go after the shiny object over here.
Yes.
Whatever the shiny object is, they're going to go after it. And it helps to sort of refine what it is you're there to focus on. And you say, usually, 4 or 5 things this company is going to do. So, for example, if you're looking at the last company that I started, our goal was to buy real estate that people couldn't buy, that they wouldn't find it. We didn't want to just buy anything that was like off the shelf. We wanted to buy stuff they couldn't get. We wanted to buy it at yields they couldn't get. So price, basically returns that they couldn't get. We wanted to buy it with documentation on the lease side that they couldn't get. We wanted to finance it better than they could. I mean, there were like 4 or 5 things that we were going to focus on, which if you're doing that, you're creating your core competency, and then your leadership team is buying into that, and they're focusing on those 4 or 5 competencies, and that's it. And they try not to get distracted by the other stuff. And maybe once a year you all meet and you sit down and maybe you create a different competency or you broom one. But that's really part of it, because when you're an entrepreneur, what happens is, day one, you're sitting around with a team of people. Then you have a company, maybe somebody backs you. You start creating a business, and then pretty soon you're hiring somebody and you're running into them in the hallway and you have no idea who that person is, right? Because somebody else hired them. And so the question is, well, how do you have this organic company that's going to operate as you want it to operate? And the way is to create the competencies to begin with, so everybody buys in.
That's so good. Man, we could dig into that forever too. Chris, thank you so much for being on here. Stephen, you added a ton. You asked a lot of great questions that I would never been able to ask. So thank you both. Appreciate you being on.
Ryan, Stephen, I enjoyed it. It was my pleasure.
All right, we'll see you next time.
You've been listening to Streams of Income with self-help author Ryan Rieger. From right here in the Dallas Metroplex, Ryan teaches several entrepreneurial courses and group coaching programs to students all over the world. Be sure to listen next week at the same time for Streams of Income with Ryan Rieger.